Welcome to the 7th installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets while also drowning out the agenda of the news media in America. So let's talk about the 4 things we learned in the markets this week. First, the midpoint between the worst, which is about 3,300, and the best, which is about 4,100 case in an S&P 500 is about 3,700. Earlier this week, we closed approximately on the midpoint at 3,765, and this means that there are equal odds of near-term corporate earnings power increasing or decreasing by about 10%. Although the most common viewpoint right now is that the market will decline rather than increase, the math presented shows that either has a fair chance of occurring. The second thing that we learned in the markets this week is that the July 4th food spending is sitting at about 4.4% growth, which is less than the annual CPI food inflation. However, Americans expected to celebrate Independence Day is consistent with last year's and up about 8% from 2020, showing that spending intention is still solid despite current inflation rates. So go have those 4th of July parties. The third thing we learned in the markets, the S&P 500 only declines by more than 17% over 100 trading days during periods of widespread macroeconomic and or geopolitical uncertainty. Prior to this year, you could count those events on just one hand. Being down more than 17% over 100 days is not quite enough to call a bottom for US large caps. However, what needs to happen in order to trigger positive returns over the next 100 days after a decline of this magnitude is some sort of either monetary or fiscal policy or a comprehensive settlement with the geopolitical issues that are happening with Russia and Ukraine right now. Fourth, Wall Street analysts are way too optimistic with their second half 2022 earnings estimates. This causes US large cap stocks to look cheap if you look at their forward price to earnings basis, their PE ratio. This has caused equity market prices to decline this year because markets don't believe in the street's estimates. A better way to examine fair value is looking at historical earnings power as an alternative right now. So those are the 4 things we learned in the markets this week. We hope that was helpful to you. I do want to remind you that investing is a long-term endeavor. These videos are helpful to provide you a current synopsis of where the market is currently at and how to move past this week and how your strategy should look past this week should incorporate a long-term horizon. Investing in a short window is definitely risky. So talk to your advisor about your long-term strategy, and if you're worried about the markets right now, what are some things that they can do to help be tactical within your portfolio. We appreciate your trust in us, and we look forward to talking to you next week.